Hi, this video covers several topics related to non-current assets and lead the discussion towards IAS 36 eventually, the impairment side. The reason that we need to cover all the different manifestations of non-current assets and then talk about impairment is to bring together all the related concepts under one logical encapsulation where you can make connections about how different standards, which are supposedly different from each other, but they're all really connected, and they give guidance related to similar way of presenting non-current assets, measuring non-current assets, identifying them for recognizing them in the financial statements, and eventually lead to derecognition and all the concepts that are related to the non-current assets and their recognition and derecognition. So without further ado, let's deep dive into the slide deck. So this covers non-current assets, and specifically, let me see if I can get this one. These are the learning objective. Now, all this learning material is based on the ACCA financial reporting study text, which is published by Kaplan, and you can find it easily in the market. What the slide deck has done is take the key concepts from that study text in order for explaining and making the key concepts clear for the students. Now, there are several learning objectives. Obviously, you should be able to define the cost of non-current assets. Now, if you're studying F7, these topics you might have already covered in your previous studies or elementary studies, but it helps to recall those key concepts and make those connections in the broader scale of things. We're talking about calculating the initial cost measurement of non-current assets or a self-constructed non-current asset. Then we are distinguishing between asset and expense item. You should be able to identify the subsequent expenditure that may be capitalized, explain the treatment of borrowing costs as per IAS 23, explain the requirement of IAS 16 in relation to revaluation. So they're all related concepts to the non-current assets recognition, measurement, presentation, and disclosure. You should also be able to account for revaluation of non-current assets, the gain or losses on disposal of those non-current assets, and obviously depreciation based on cost model or evaluation model, or assets that have two or more significant parts, the components which make up a single asset like an aircraft. Related concepts include IAS 20, which includes discussion on government grants related to assets or expenses, and also IAS 40, which covers investment properties, and you should be able to discuss why the treatment of investment properties should differ from other properties and apply the requirement of IAS 40. And last but not the least, explain and distinguish intangible assets and discuss their accounting treatments. So in the overall scheme of things, you start off from the tangible non-current assets. You also have a discussion on investment properties. The measurement part comes in IAS 16. That's something that you might have already discussed and studied. Then in related to that, you have two concepts from IAS 16, the depreciation part and the revaluation part. Obviously, in depreciation, we're going to talk about change in method, change in estimate, components, and overall costs. In the revaluation part, we are going to talk about accounting, depreciation, disposal. Two concepts related to non-current assets: borrowing costs, government grant, and in the government grant you have two types: revenue grants and capital grants. Starting from the basics, what are property, plant, equipment? Obviously, these are tangible assets which are held by an entity more than one accounting period. If it is less than one accounting period, it's a non-current asset. It's a current asset. So property, plant, equipment, these are tangible assets. These are held by an entity for more than one accounting period, and the purpose is production or supply of goods or services for rental to others or for administrative purposes. Whenever we're talking about any element of financial statement, we are going to talk about 2-3 different concepts. We are going to talk about recognition, we are going to talk about measurement, we are going to talk about presentation and disclosure. So in the context of property, plant, equipment, recognition has this criteria. PPE is recognized as an asset when it is probable that future economic benefits associated with the assets will flow to the entity. That's one criteria, but it is composed of 3 different concepts which we are going to touch upon. And Second criteria, cost of the asset can be measured reliably. So these two are the criteria you have to apply in order to be able to recognize property, plant, equipment. Now, in the first criteria, it is probable that future economic benefits. So the points to note here: A is the probability, the B is the future economic benefits. Future economic benefits which are associated with the asset and will flow to unconditionally or exclusively will flow to the entity, not to a group of people, which will also include the entity, just to the entity exclusively. And then cost has to be reliably measured. And whenever we're talking about measurement, we have to distinguish between two stages of measurement. The first is the initial measurement. The second is the subsequent measurement. So subsequent expenditure could be expenditure that you incur on the asset and subsequently after acquisition. Now, on the initial measurement, it should be on cost. Now, there's an asterisk on cost here. Let me see if I can pointer option. Yep, I do have a laser pointer option. Okay, so cost, expense items such as fuel or training, warranty cost should be written off as incurred, so they're not included in cost. But what is included in cost? A, all costs included in bringing the assets into working condition. That's one. And dismantling costs. So these are two stages. The first one, you can measure reliably today. Obviously, if it's a big asset, you are preparing the site, you have a cost of site preparation, you have the delivery costs. If you're shipping power plant parts from abroad, there are shipment costs, insurance costs, and all the other related costs, installation costs. Then you've got borrowing costs if you are acquiring the asset based on borrowed funds, specifically or from general borrowings. So all of these costs are applicable today. And if you're acquiring an asset, if you're constructing an asset, if you're buying an asset, you do have access to all of that information in order to ascertain what is the cost involved in bringing this asset into working condition. But how about dismantling cost? Dismantling cost is something that is not clear right now. It's going to be incurred somewhere down in the future at the end of the asset's useful life, hopefully, if the asset does not get damaged before that. So that's not a cost that you're incurring today. You're going to incur that cost probably several years down the road. If that is also part of the initial measurement, then it cannot be taken as is. For example, if you are acquiring a power plant, if a power plant is actually importing that, if a company is importing that power plant into the country, and they know that after 25 years they have to incur a dismantling cost, so that to return the land in the raw form back to the government, then they know that after 25 years, the cost that we're going to incur, we will have to calculate the present value of that dismantling cost today and then capitalize that cost. And obviously you should have an equivalent liability set up, because you are recognizing an asset. There has to be a second leg of the entry, so that liability has to be set up. Now, discount on liability unwound over the period until the liability is paid. That is, liability increases by interest rate annually, charged to finance costs. This is the present value standard formula. So every year that liability gets a little bit increased, so that by the end of the useful life, all things remaining constant, if your estimate was, for example, $5 million are going to be incurred on the 25th year, you might have started off at a cost of like $1.5 million. And then every year, a certain component gets added into the asset cost, and the liability consequently is increased, and by the end of the 25th year you have $5 million sitting in that liability account, and related amount has been added into the assets carrying amount. Moving forward, just an illustration. I gave an example of power plant. Kaplan talks about an oil rig. So if an oil rig was built in the sea, the cost to be capitalized is likely to include the cost of constructing the asset and the present value of the cost of dismantling it. If the asset costs $10 million to construct and would cost $4 million to remove in 20 years, then the present value of dismantling costs must be calculated. If the interest rate for 5%, the present value of the dismantling costs are calculated as follows. $4 million multiplied by 1 divided by 1 plus the rate of interest raised to the power number of years on which to compound, which is 20, you come up with a value of $1.5 million. The total to be capitalized today will be $10 million plus the $1.5 million, resulting in a asset initial measurement value of $11.5 million. This would be depreciated over 20 years. So 11.5 million divided by 20 is about $575,000 per year. This would be depreciated over 20 years. Sorry for the duplication here. In year one, this would mean that the liability increases by $75,000, making the year-end liability 1.582 from 1.507. This increase is taken to the finance cost in the statement of profit or loss. Another test your understanding. Now you can pause this, do it further down the line in the slide deck. I have added solutions as well, but here I have not included the solution, so you can go through this exercise and then try to do it on your spare time. It's an entity is starting construction, has started construction on a building for its own use on 1st April 2007 and incurred these costs: purchase price of land, stamp duty, legal fees, site preparation and clearance, material, labor, architect fees, general overhead, $583,000. $583 million actually, it's $1,000 above. Now some additional information. Material costs were greater than anticipated. On investigation, it was found that the material costing $10 million had been spoiled. So where's the material? Material is $100,000, $100 million, and out of the $100 million, $10 million had been spoiled, okay, and thereof wasted. And a further, so if you pause just here right now, obviously you can do it on your own, pause this video, but I'm going to discuss some pointers on the solution on the way. This $10 million, this has been wasted. This cannot become part of the cost. This has become a wastage which cannot be capitalized. It has to be recognized into the P&L as an expense today. It cannot be matched to the useful life of the asset for 20 years or whatever the useful life of the asset is. So that $10 million has to be removed from here. No question asked about that. And a further $15 million was incurred on material as a result of faulty design work. Again, this is an error. So if you incurred additional costs because of an error, you should not be capitalizing that error into account and utilizing, expensing it out over the useful life of the asset. If it is an abnormal cost, the abnormal cost should be recognized in the P&L on the year in which it was incurred. As a result of these problems, work on the building ceased for a fortnight during October 2007, and it is estimated that approximately $9 million of the labor costs relate to this period. Again, now if we this 1st April to 1st July, so 1st April from 1 year to this 1st July of the second year, so that April, May, June, July, August, September, October, November, December, January, February, March, April, May, June, July, so that's 16 months. So this labor expense of $150 million, this is an expense for 16 months, and but of those 16 months, the work on the building was ceased for a fortnight, so about 14 days. The labor costs relate to an abnormal closure, and for that abnormal closure, the related cost out of the $150 million is $9 million, and that $9 million should not be included into the cost of the asset because it is an abnormal cost. Now, the building was completed on 1st July 20x8 and occupied on 1st September 20x8. So the completion was on 1st July. Occupied was on 1st September. Calculate the cost of the building. Now, you have the labor cost till July. Thankfully, it does not include the cost till 1st September. It should not be, you don't, apart from the $9 million, you don't have to remove any other labor component. Now let's see. Purchase price of land, direct cost, stamp duty, direct cost, legal fees, direct cost, site preparation and clearance. Obviously, materials apart from the two adjustments, labor apart from the one adjustment, architect fee definitely. General overheads, not so much, because general overhead are not necessarily related to bringing the asset to the working condition. So the cost of 583 will have a adjustment of all the discussion that we did. But this little piece of information, the building was completed on 1st July 20x8 and occupied on 1st September 20x8. This should tell you that when to capitalize that asset. So 1st July, the asset was ready. It should be in that condition. And if we go back to the definition, all costs involved in bringing the asset into working condition. The asset was brought into working condition on 1st of July. So you might not have the building occupied for another year or so. That doesn't mean that you don't start depreciating the asset. You have to capitalize on the day it was ready and available for use. So that takes care. Oh, we have a solution here. Sorry about that. So what's happening here? Key points. Only those costs which are directly attributable to bringing the asset into working condition for its intended use should be included. Administration and a general overhead cannot be included. So $30 million has been excluded. Costs included should only be normal, not abnormal costs. Spoiled material and faulty design are abnormal costs. So $25 million removed. $9 million labor cost incurred during the period of stoppage is an abnormal cost and is excluded. So out of the 583 million, 64 million gets charged into the P&L in the year, in the same year, and $519 million is something that gets capitalized. Moving forward, again, I'll pause and always remind that whenever we're talking about any element of financial statement, we're talking about several repetitive concepts. The first was initial measurement, first was recognition, the second was initial measurement, and then you have subsequent measurement or subsequent expenditure. Let's talk about subsequent expenditure in the context of non-current asset. Only treated as part of cost if, because you have a choice. If you have incurred, like for example, this constructed asset which cost you $590 million, you might incur another $10 million 3 years down the road because of overhaul of which, as plants or aircrafts, they do require periodic maintenance, which are not normal maintenance. They extend the useful life by a certain amount. And so any subsequent expenditure is only treated as cost if, okay, there are three criteria. It enhances economic benefits provided by asset. Okay, so we have talked about economic benefits provided by assets. We know whenever we are talking about an asset, we are talking about certain economic benefit that we expect to flow from that asset, from the use of that asset or from the asset directly. Whatever this expenditure is, either it's enhancing the economic benefits provided by an asset. For example, if I have a uninterrupted power supply system, it has a battery of which provides me a backup of 5 hours. I'm incurring another expenditure which increases my 5-hour backup to 7 hours backup. Now that has enhanced the economic benefit that is provided by this asset. That's one criteria. Relates to an overhaul or required major inspection. Okay, now overhaul means something that is getting repaired thoroughly. For example, if a power plant gets overhauled, that means it's all of its engine, the turbine, everything gets repaired. Some parts are removed, a whole exercise is done. Just like more of your car maintenance, you might have a 10,000 kilometer car maintenance or 5,000 kilometer car maintenance, and every milestone has different requirement. You have to change the oil every time. You might need tuning only after 5,000 kilometers. Some I'm not a big car geek, so some different level of inspection that goes on. Major inspection is always related to that. Now there's an asterisk there. Costs capitalized and depreciated over the time until the next overhaul or safety inspection. I repeatedly give an example of power plant. Now power plant, may have a useful life of 25 years, but the overhaul that a power plant undertakes may happen every 5 years. So if I'm incurring, maybe the plant cost me $250 million, but an overhaul might cost me $10 million. Now the plant might have a useful life of 25 years, but that overhaul will be needed after 3 years. So you can understand that the expense that I'm incurring for the overhaul does not have the same useful life as the plant, because after 3 years I'll need another overhaul. So the maximum I can depreciate this $10 million is 3 years. Okay, this overhaul cost is 3 years till the time I need another overhaul, I need another major inspection. That's the time that you need to break that expense into. It's all about matching the expense to the right year. So if I'm in expense, if I'm paying $100,000 to a OEM vendor of a power plant, $10 million to an OEM vendor of a power plant, that expense should not hit my P&L in year one. It actually has a life of 3 years, so it will hit three economic periods, three financial periods: year one, year two, year three. The method could be straight line, could be reducing balance, but it has to impact three different financial reporting periods. So that was criteria 2. Criteria 3: replacing a component of an asset made up of a number of components. Aircraft. An aircraft has several different components. First, it is the frame, then they have the seats, then they have the engines. In fact, the tires are also separate. So every as component of an aircraft has a different useful life. And if a subsequent expenditure is actually replacing a component of an asset made up of a number of components, for example aircraft, then that cost needs to be capitalized, and obviously the replaced component will be de-recognized. So for example, if I had tires of an aircraft, a Boeing 777 and or Airbus so we don't want to take sides. If an aircraft has tires which have a useful life of 5 years, and I'm incurring a new expense to change all the tires of my 777, I would de-recognize the old tires, which might already been depreciated for 5 years and may have a very nominal useful life carrying amount, and then I'm going to add up the cost of the new tires into the cost of the aircraft. So that cost will be added and then depreciated, not necessarily till the life of the aircraft. Aircraft might have the frame, the engine, they all might have a very different useful life. And then all other subsequent expenditure recognized in P&L, because it maintains economic benefit. So any other expense that you are incurring, it's not enhancing economic benefit, it's not related to an air overhaul or a major inspection, it's not replacing a component. These three criteria are not met. That means we are just maintaining the economic benefits related to that asset. Okay. Illustration. A piece of machinery has an annual servicing cost $10,000. During the most recent service, it was decided to replace part of the engineering, meaning that it will work faster and produce more units of products per hour. The cost of the replacement part is $20,000. Is this asset or expense? You can pause, wait for the mystery, or you can just give a guess. $10,000 service cost is an expense item. You have to write off to the P&L. This was regular maintenance. It was maintaining the economic benefit. However, the $20,000 replacement part enhances the future economic benefit, and so is an asset. Increases the cost of non-current assets in the statement of financial position. Now, let's move towards depreciation. What is depreciation? This might be a repeated concept to you guys, but focus on key concepts related to depreciation. Depreciation is the systemic allocation of the depreciable amount of an asset over its useful life. So two concepts: depreciable amount and useful life. Depreciable amount is the cost of an asset. That was the first thing that you recorded, or other amount substituted for cost. Okay, there could be some amount substituted for cost, less its residual value. Okay, so what could be a situation where you would need to substitute an amount for a cost? You might acquire an asset through other than procurement. You might need to assign it a value based on proxy measure, maybe a market value or something like that. So depreciable amount is some cost or a proxy of a cost attributable to that asset less its residual value. You have to ascertain whether the asset has a residual value or not. Okay. Key points. It must be charged from the date the asset is available for use. In the earlier example, when we're talking about that constructed asset, it was ready in July, but it got occupied in September. Doesn't matter. From July, the asset is available for use and it should be depreciated. If it is a power plant, you are spending time, resources, money, and labor and materials to construct that power plant. It got constructed, it became available for use, but for some regulatory purpose or for some contractual reason, it cannot start production because of the the legal rights have not been signed off with the government. And so although the asset is available for use, but you're not actually using it, and in practical world, people can get creative that we should not be charging depreciation unless we were using that asset. Sorry, that's not how the standard works. You have to charge depreciation from the time the asset became available for use. For example, which means that capable of operating in the manner intended by management. Whether you're not using that is it's totally your own management decision. Now, this ensures that if two organizations are following that same timeline and they construct the same power plant or they construct the same building on the same timeline, one starts using immediately, the other one does not, the financial statements are going to be widely different. So it should not. The consistency principle demands that you have to have similar principles for both the parties. This date may be earlier than the date of actually being brought to use. Okay, the depreciation method. It should reflect as fairly as possible the pattern in which the asset's economic benefits are consumed by the entity. Okay, now this is usually people don't give a lot of thought to this, but when we're talking about hundreds of millions of dollars being charged to P&L and the amounts are significant as far as depreciation is concerned, then the management has to really think that what kind of depreciation method do they want to achieve. The decision. This clarification is there so that the decision is not financial. That, for example, new venture companies may decide that let's start with a straight line method, which may give us an even sort of expense every year in the financial statements. Or some might say that okay, in the initial years we are expecting low profitability, so let's start with the reducing balance method so that to have maximum losses accumulated in the earlier years, and then later on we can use those losses to set off against the income for getting tax benefits. The decision does not have to be like that. The decision has to be in the context of the pattern in which the assets economic benefits are consumed. So if it's a motor based asset which operates very effectively in the first few years of the life, and then starts losing its efficiency in the later years of its life, then maybe reducing balance is the right approach. If it's an asset that produces a very finite discrete quantity of goods and products per hour, maybe machine hours, or product count basis is a better reflector, because assets can have a useful life. For example, a packaging machine might have a capacity of 3 million boxes throughout its lifetime, and you can measure the depreciation according to that then. Or you can go for a simpler straight line basis, which might be reflective of a pattern of economic benefit in real estate or some other. So the decision has to be the pattern in which the assets economic benefits are consumed by the entity. Change of depreciation method. When we are talking about financial reporting, you have to understand that and I had this context and nuance because of my background in financial crime and fraud examination. Financial statement fraud is the most expensive fraud, as per the annual survey that Association of Certified Fraud Examiner conducts. It's the most frequent fraud is asset misappropriation, but it's not the one that causes the major damage. The major damage is caused by the financial statement fraud. A lot of creative accounting is done, and one of the lesser use is to swap between the depreciation method in order to change the pattern of expense being recognized into the financial statement. One of them, obviously, it is allowed. It is permissible if the new method will give fairer presentation of results and financial position. The management should be able to explain to the stakeholders and the auditors that the new method, it will give a fair presentation of the results. This is a conversation that usually the auditors have with the financial leadership, financial statement preparing leadership, the CFO and the financial controller, that how is it that the new method is going to be giving a fair representation, and the auditor might disagree as well. It is not a change in accounting policy. Now, this is a separate accounting standard which deals with how the impact of change in accounting policy should be dealt with. But this is not a change in accounting policy. The policy is to depreciate an asset or keep it on a historical cost model. It is a change in accounting estimate, though. So, carrying amount written off over remaining useful life starting from the period of change, obviously, and then componentized asset, each separate part is depreciated over its useful life. So if when a change in a depreciation method occurs, then whatever the carrying amount is written off over remaining useful life starting from the period of change based on the new method that the organization has adopted. Another illustration: an asset costing $100,000 and has an expected useful life of 10 years. The purchaser intends to use the asset for 6 years, at which point the expected residual value will be $40,000 at current prices. What is the depreciable amount? Fairly simple. The depreciable amount is the cost minus the residual value, which is $60,000 spread over 6 years. It's roughly on a straight line basis, $10,000 per annum. Review of useful life and residual value. Now, these residual values and the useful life, they should be reviewed at the end of each reporting period. At the end of each reporting period, this should be reviewed. When we'll discuss impairment, we'll also understand that the impairment also needs to be reviewed every year. So there are several things that need to be reviewed every year, and maybe every few years if you're using a revaluation model, which we'll see slightly further down the road. Revised if expectations are significantly different from previous estimates. Carrying amounts at the date of revision minus residual value should be depreciated over remaining useful life. Another illustration. I'll pause for you guys to read. So, an entity purchased an asset for $20,000 on 1st Jan 20x3. Straight line depreciation of $5,000 per annum has been charged, assuming a 4-year useful life with no residual value. On 1st Jan 20x5, the annual review of asset lives was undertaken, and the remaining useful life for the asset was estimated at 4 years. So, on 1st Jan 20x5, so 2 years have passed, and the remaining useful life is again estimated at 4 years. So you started off from a 4-year useful life, and then the revised useful life after the expiry of 2003, 2004, 2 years is another additional 4 years, not the remaining 2 years. The financial statement for the year ended 31st December 20x5 are being prepared. What is the depreciation charge for the year? So the carrying amount on that time is $20,000 minus 2 years of $5,000, $10,000. Remaining useful life is 4 years. So annual depreciation charge means that revised the carrying amount at that year end divided by the remaining useful life, which is $2,500. Major inspection or overhaul cost, we covered slightly earlier, is generally expensed as incurred. Okay, so the primary rule is if you are carrying out an inspection or carrying out a repair work, it is expensed. But it can be capitalized to the extent that they satisfy the IAS 16 rules for separate components. what are the rules for separate component? These are capable of being used independently, capable of generating a measurable inflow of economic benefits. Second, it has a different useful life from the asset. So the power plant may have a useful life of 25 years, but the overhaul cost may only be useful for 5 years and would need to be incurred again for another 5 years. And lastly, cost can be measured reliably. I'm sorry for a little bit interruption between there. The software had a little glitch. Finally, the depreciation over useful life until the overall cost is depreciated over the useful life until the next overhaul. Let me just pull up the pointer. Okay, until the next inspection or overhaul. Now, illustration. In this illustration, we are using an example of an aircraft with a useful life of 20 years, no residual value. We don't want to complicate things a little bit right now. Substantial overhaul at the end of year 5, 10, and 15. Let me just pull it back. The cost of the aircraft is $25 million. $5 million is attributable to the benefits that are restored by overhauls. Now, this sort of information has to be given in the question because otherwise you cannot assume that what economic realities attached to the overhaul cost. So the question will give you that what are the the identifiable benefits, components of cost that are related to the overhaul cost. Or if the question wants to complicate it a little bit, this information will be complicated. You will have to derive this information, but somehow you'll have a component of a cost that is supposed to be treated as separately. The cost of overhaul at year 6 is $6 million. Now you need to calculate the depreciation charge for year 1 to 5 and 6 to 10. So how is that going to go about? So the year 1 to 5, which is the year from getting the asset till the time of the first overhaul, the $20 million component, that is the asset life, which is supposed to be depreciated over the 20 years, is going to be $1 million per annum. But the $5 million cost component that was attributable towards the overhaul cost has to be depreciated till the next time the overhaul is due, which is after 5 years. So $5 million will be depreciated over 5 years, resulting in a depreciation charge of $1 million per annum. So depreciation charge of $2 million per annum will be charged from years 1 to 5. At the end of the year 5, overhaul of $6 million is capitalized and depreciated to the date of the next overhaul. So $6 million gets capitalized back in the asset cost. In the year 6 to 10, again, the aircraft depreciation does not change. That $20 million is being depreciated for 20 years, resulting in a depreciation charge of $1 million per annum. However, the $6 million cost will then get depreciated over the next 5 years, resulting in a depreciation charge of 1.2. And the total depreciation charge per annum will be $2.2 million. And now the next component related to non-current assets, which is the revaluation of non-current asset. Now, if you are acquiring property, plant and equipment, you always have a choice of between a cost model and a revaluation model of how to show these assets in your statement of financial position or balance sheet. The cost model records the assets at cost less accumulated depreciation. The revaluation model records assets at revalued amount less any subsequent depreciation. Subsequent depreciation means subsequent to the revaluation. We'll see what that means. Now, there are certain conditions for the revaluation model because and the choice of this model affects how the depreciation charge is shown into the statement of profit or loss, and how what is the carrying amount in the statement of financial position. So it does affect how your ratios stand, how you are reporting the annual profits. So you have to be really you have to have strong reasons for the choice of the model to be adopted. If the revaluation alternative is adopted, you need to comply with two conditions. One, revaluation must subsequently be made with sufficient regularity to ensure that the carrying amount does not differ materially from the fair value at each reporting date. Now, this could be the reason that why you are choosing a revaluation model over a cost model. For example, an airline has a subsidiary. The Pakistan International Airline also has a subsidiary which owns two luxury hotels, one in Paris and one in Washington. I don't know, one of them has already been sold yet, but hotels in luxury, in elite neighborhoods, they rarely are, adequately represented at their cost, the cost of construction or the cost of acquisition like 20 years ago. So they need to be represented at fair value so that your financial position is as accurate to the market realities as possible. In that case, the choice of revaluation model is more appropriate. But do you revalue a hotel every year? No, you don't revalue. I'm sorry, I keep looking at the small reflection that I have of my own on the screen, but I should be looking at the camera. So, should you do it every year? No. The sufficient regularity means that your estimate should not be very much away from the fair value. So it may not be every year, but it should definitely be done with sufficient regularities from, for example, 2 to 3 years, so that you are close to fair value. There could be extraordinary circumstances. For example, the property values may plummet due to some financial crisis, in which case there could be a case that although you did have a revaluation last year, you need to do another revaluation because the market conditions are abnormal now. Okay, so what's the second condition? Second condition is when an item of property, plant, equipment is revalued, the entire class of assets to which the item belongs must be revalued. So in the case of, for example, of the luxury hotels in Paris and Washington, so there are protests going on in Paris, so the property values might be adversely affected. There's nothing going on except for the Trump's arrest, possible arrest in Washington. So management might get creative and say that we are going to value the Washington hotel on fair value, on a revaluation amount, and continue to value the Paris hotel on cost model. That's not permissible. The standard says that if you choose a model, you have to apply that model to the entire class of the assets that belong to that category. Okay, so how does it, what is the process that happens when you do a revaluation? First, you restate the cost to new valuation. You know the valuation now, the cost has to come to this amount. This amount will be, the asset value has to be the new valuation amount. You eliminate whatever the existing accumulated depreciation you have had. You obviously have been depreciating for 2 to 3 years. Whatever accumulated depreciation you have, it gets eliminated. And then whatever the increase is, you show it in the other comprehensive income and take it to revaluation surplus. So revaluation surplus gets credited, the property, plant, equipment value gets debited, and the accumulated depreciation gets eliminated. Recognizing revaluation gains and losses. Again, this is a theme. Whenever we're discussing a new concept, the first thing that comes is recognizing, and then the measurement aspects of it. It is recognized as a component of other comprehensive income. The gain is carried in revaluation surplus in equity. This is a capital reserve, not distributable to the shareholders. Revaluation losses are definitely impairment of asset value. These are recognized in profit and loss, but first they need to be deducted against any gain from previously revalued asset. And as we see further down below, the offset between gains and losses of different properties is not permitted. So you cannot really take the gain from property A and set it off against any loss from property B. So if property B is getting a loss, the property B does not have any prior revaluation surplus, this impairment loss has to go into the P&L. And excess impairment recorded as impairment expense in P&L. Illustration. I'm sorry, this table is just showing because of the animation effect has not been applied yet, but let's look at the facts. There's a building that's on revaluation model. On 31st December 20x7, the cost of the building was $1.2 million. The depreciation was $144,000. Carrying amount was $1.056 million. This is 31st December 20x7. Now, in the question, it's not going to be listed as such. So the way I've bulleted down is you should also aim when you are reading that big chunk of text to note down facts this way, so that you are also keeping this information in a very easy to use, easy to refer bullet form, so that when you're solving a question, you are not facing any difficulty. Revalued at 1st Jan 20x8 at $1.4 million. So it was 1.2, you charge some depreciation, it was standing at 1.056, but now it needs to be $1.4 million. Useful life at that date is 40 years. Show relevant extract of financial statements. On the asset side, you have basically land and building on 1st Jan 20x8, it was $1.056 million. You got a revaluation gain of 344. Okay, how did you get the revaluation gain of 344? This is where you get it. This is a balancing amount. The 1.4 is the balancing amount. The valuation of $1.4 million, that needs to be the ending value, and the delta between these two is 344. How does it get distributed is here. 200 is the addition that you need to show on the valuation side. 1400 minus 1200, 200. And the accumulated depreciation, which was 144, sets off to 0, showing you total revaluation surplus of 344. And the depreciation for that year definitely needs to be on the new amount divided on 40 years, which is the life. And so $35,000 is the depreciation, and the ending carrying amount is $1.365 million. So pretty simple. You take the new value minus the old cost value, and this is the delta that needs to be added into the asset amount. You eliminate any previous depreciation, and then you start using the new value, depreciating it on an annual basis. So depreciation of revalued asset has just one little nuance related to compared to any depreciation on a cost-based model. Now the new depreciable amount is obviously the valuation amount minus residual value divided by remaining useful life. So this is the new depreciable amount. Obviously this valuation is higher than the cost, so this depreciable amount is also higher. That means the depreciation is also higher. So as this depreciation on revalued amount is charged to P&L, it results in a higher depreciation expense compared to depreciation expense based on cost. So to address this imbalance, IAS 16 permits, meaning you can make a choice on it, it permits an annual transfer from revaluation surplus to retained earning through statement of changes in equity. This transfer should be equal to the additional depreciation charged. So the delta between the depreciation on higher revalued amount and the depreciation on cost model, the delta is to be transferred from revaluation surplus to retained earning, so that the imbalance is balanced out. And this is a policy, so you can choose to have this policy, you can also choose not to have this policy. If you have this policy, by the time you are either recognizing a new impairment loss or you're disposing of the asset, your revaluation surplus might have already been released towards the retained earnings slowly to compensate for the higher depreciation expense. If you don't, then you would have the entire revaluation surplus intact at that time. Okay, so this is the normal depreciation entry, and this is the revaluation surplus. Hold on, let me pause. Okay, so revaluation surplus gets debited and retained earning get credited. It's not routed through P&L, it's routed through the statement of changes in equity. Okay. Test your understanding. Information. You have a revaluation model. You have a revaluation surplus that relates entirely to the property. Now, why is this information given? Because to eliminate any confusion that revaluation surplus is not a composite of different properties. It is a revaluation surplus related only to the property under question. The policy is not to transfer to realized profit in respect of excess depreciation. So there's not going to be any transfer from revaluation surplus to retained earning. Prepare extract of financial statements. How accounting would be different if opening revaluation surplus didn't exist. So what is the information given? The fair value of the property on 1st April 20x8 is $100,000. You have a remaining useful life of 20 years. On 31st March 20x9, April 31st March, 1 year later, $86,000 is the revalued amount, and the balance on revaluation surplus on 1st April was $20,000. So what's going to happen? First, look at the revaluation. Leasehold valuation at 31st March 20x9 is $86,000. What was your carrying amount? The carrying amount was $100,000 minus $5,000, which is 1 year's depreciation, $95,000. So you actually have a loss on revaluation of $9,000. Okay, and so depreciation, you have $5,000. You have another comprehensive income revaluation loss of $9,000. On the financial position, statement of financial position side, you have a balance at 1st April 20x8 revaluation surplus $20,000, and which is now getting a deduction of $9,000 revaluation on leasehold building, resulting in the ending revaluation surplus of $11,000. So hold on. So this is to show that how revaluation surplus is then accumulated. Okay. Another example, revaluation of land and building at start of year, $60 million, of which $15 million is related to land. So land and buildings, $15 million is for land, $60 million is for the entire value. Cost 10 years prior to the revaluation is $30 million, of which $6 million was for land. So total expected useful life is 40 years unchanged at revaluation. The policy is to make annual transfer of realized amounts to retained earning. As compared to the previous example, the policy is to make the annual transfer so that to balance out the depreciation expense. Now show the impact on financial statements. Now this was the new statement. So when you are giving an answer, you have to show that what is the impact on the statement changes in equity related to the depreciation charge. Okay, so the cost, obviously $30 million was the cost, $6 million was for buildings, 24 is the delta, which is obviously related to the buildings. The carrying amount was $24 million, of which $6 million definitely is for land. It did not get depreciated, which means that $18 million is related to the buildings. Now revaluation gave a value of $60 million, of which $15 million was for land. So that means $45 million was for building. This whole thing is the balancing amount. Okay, 60 minus 24 is 36, 15 minus 6 is 9, and obviously the 27 is the delta for buildings. So this is how you get the revaluation gain. Now what's the depreciation? The life has not changed. It was 40 years, 10 years have already passed. So you take this 45 and you divide it for 30 years, you get a $1.5 million per annum depreciation charge, and you end up with this carrying amount at the end. Now the old depreciation you were charging was obviously $24 million divided by 40 years, which was $600,000 per annum. But the new depreciation is $1.5 million per annum, which means that the annual transfer required is $900,000. So what's going to be the representation in the financial statements? At the end, you're going to show in the statement changes in equity a transfer of $900,000 from revaluation surplus to retained earning. Okay, now finally the disposal of revalued non-current assets. So P&L and disposal is fairly simple. You have the net sales proceeds minus the carrying amount, you get the profit or loss. Now there are two steps of disposing of a revalued asset, accounted for in the statement of P&L of the period in which the disposal occurs. So no rocket science here, it has to be the same period in which the disposal has occurred, and any balance on revaluation surplus is then transferred to retained earning. This does not affect other comprehensive income, which only gets affected if a revaluation gain or loss occurs. So other comprehensive income will only get affected if there is a revaluation gain or loss. So this is a summary that's going to happen on the disposal. Let's see. Okay, so I'll pause, end this video here, and then cover the separate, IS 20, IS 23, and then impairment in a separate video, because this has already been a significant length for a video. So I'll see you in the next one.